Hi, and welcome to our first training session together. This is a picture of a monkey, and in a matter of minutes, you'll discover why this monkey holds the secret to your success in trading. Now, look, most traders will never be consistently profitable because they try system after system and nothing seems to work. Money and savings are lost, and hence they get frustrated and angry. So in today's session, we're going to go through the stress-free trader system. So you have a proven system you can follow and build your confidence with. So at this point, you're probably thinking to yourself, who is Alberto Pau and why should I believe anything he says about trading? Well, look, I don't want you to believe anything I have to say blindly. It's probably a better idea if you put into practice the things I'm going to share with you today, and you'll see the magical effect for yourself that it can have on you and your trading. Look, I can still remember the very first trade I placed. It was just at the end of the dot-com boom, and no matter what people bought in the market, everything seemed to go up and up and up like there was no tomorrow. I was seeing people getting new cars and new houses just off the profits that they were making by just buying and holding the market. One guy I remember bought a brand new yacht and named the yacht after the trade he placed. That's how much money that position made him. I also wanted a piece of the action, but I was completely overcome with fear that the moment I would buy, the market would go down, turn against me, and I would end up losing the little hard-earned money that I had saved. I was young and I was dumb. So I decided to jump in and buy the market just like everyone else. My quote-unquote strategy of following everyone else was buying the market, waiting and praying that the market would go up. And lo and behold, that turned out to be a very stupid idea. Because just 2 days later after I bought, the market started its post-dot-com boom collapse that eventually led it to lose 87% of its value. The market, since the time I bought, went down 87%. Can you believe that? So, as you can see, being a profitable trader is not something anyone's been born with, but it is something that anyone can learn to become. However, let me make a distinction. What you are about to learn here is not your run-of-the-mill classical trader training. Look, there is more than enough gurus out there doing that already. What you're about to learn are the techniques that can make you a profitable trader inside months, not years, and may make you thousands, if not tens of thousands and hundreds of thousands from trading the financial markets. So this is exactly why I developed the stress-free trader system, so that when you place trades, you'll be a more confident and more profitable trader. I have people connecting on my trainings from all over the world. Not just to learn this, but to put into practice what they learn and at the same time get real-time feedback and mentoring on their trading. So, only continue to watch this if you're committed to putting this into action in your trading so you too can perfect your trading skills. So, what I want you to do now is go and get a pen and a piece of paper. And once you've done that, I want you to go ahead and write the word system on the side of the page, just like I have here. Alright, the very first step in the stress-free trader system is so important that chances are, if you fail to pay attention, you'll never be able to identify the beginning of a trend. And even worse, you'll expose yourself and your account to the market slapping you in the face. So, what is the first step? The very first step is to identify 3 key elements in a chart. The first element is a sharp move down in the price. The second element is a sideways movement in the market, So the market is yielding along before going into the third phase, which is a sharp movement up. So we're looking for a sharp movement down, followed by a yielding period, followed by a sharp movement up. Simple, right? Why is this? Well, because banks and institutions, when they trade, and they are the ones who are making most of the money, right? They're the ones who are making insane amounts of money year in, year out, right? So they are the ones who can move the markets. And what that means is that when they place trades, they come into the market with very large sizes. The issue is that if they put through all of their volume in one go, that would cause prices to move against them. And they don't want to do that. So what they do is what is called chunked execution. What that means is that they split up their large volume into smaller orders that can be easily absorbed by the market. They put through a small order, wait for that to be executed, then put through the following one, and so on and so forth. So let's say that you're Goldman Sachs and you have 1 million contracts to buy. You start putting through orders in the market. Let's say you put the first order in for 200,000 contracts and it gets executed. Great. You put through the second order in the market also for 200,000 contracts. But this one takes a little bit longer before it gets eventually executed. You decide to kind of play it very safe and you place your third order for only 100,000 contracts. Now what happens there? The sellers completely dry up and the price shoots up. Your third order of 100,000 contracts does not get executed. You filled 400,000 of your million order. And now what happens? The price has gone up, you can't buy anymore. Now let me ask you this. What do you think is going to happen the moment the price comes back down? Well, the moment the price comes back down to your target order level, Goldman Sachs will be continuing to buy, right? Because they have to get the rest of their order filled. So after trading on the pit, on the exchange, I noticed that this type of bank activity was leaving a very clear footprint on a chart. In other words, I noticed that I didn't physically have to be trading in the pit to know when the big banks, when the smart money was trading, because they were always leaving this specific footprint, this specific pattern on the chart. And this is exactly the S.Y.S. pattern. It tells us where the banks are buying and selling the market so that we can buy before they buy and we can sell before they sell. We can buy low, sell high, and piggyback off their trading activity. We're looking for a pattern like this. It's very simple. We've got the red box here, which is a sharp move down, followed by an area of yielding. So the market is moving along without doing much, and that's the blue rectangle. And finally, we have a sharp movement up, which is the green rectangle. That's it. Let's take a look at this chart. Here, you can see how we have a sharp move down. Very sharp. 3 candles, very quick, very violent move down. Then the market yields for a few candles, a couple, before going up in a very sharp way as well. It's not as sharp as on the way down. Markets tend to go down a lot faster than they tend to go up. But still, it's a sharp movement up, and eventually the market goes up and ends up closing higher than where it started coming off from. The banks and the smart money, like we said, are making insane profits year in, year out from the markets, whilst the remaining 90% of traders are consistently losing money. So which one are you? These patterns are out there on the charts for everyone to see. Now, how many pips are you making? And how many pips are you leaving on the table? Next, get this right and your profits will be frequent and large, and your losses will be rare and small. Get this wrong, and you'll end up being the lone idiot who gets run over by the market over and over before you even notice. This is a time frame. So what is the time frame in trading? The time frame is the periodicity with which price is displayed on a chart. The time frame mostly applies to candlestick charts, and we're going to see an example in a second. On a candlestick chart, each candle represents the period of the time frame. So for example, on an M15 time frame or a 15-minute time frame, each candle represents the price in those 15 minutes. On an M30 time frame or a 30-minute time frame, each candle represents the price in those 30 minutes, and so on. Before we place any trade, we need to make sure that the current and the higher time frame agree. If you're trading the M15 time frame and you're looking to buy the market, then before you do anything, you must check that the M30 time frame gives you a signal in the same direction, i.e. to buy the market. Let's take a quick look at this USD CAD chart on the M15 time frame. We can see here that we have a very clear S.Y.S.T.E.M pattern. A sharp move down, a period of the market yielding, and a sharp move up. So, before we do anything, one of the filters that I teach in my Forex Income Accelerator Masterclass is checking that the higher time frame confirms your signal. So in this case, the higher time frame is the M30 time frame. So, what do we have here? The same S.Y.S.T.E.M pattern, and therefore the higher time frame, the M30 time frame, is confirming the M15 time frame buy signal. When you look at higher time frames, the pattern and the trend direction is not always this clear. So make sure to pay close attention at my following trainings where I share with you my trend spotter system, which gives you a step-by-step formula to spotting the direction of the trend in any market and any time frame. This reminds me of Warren Buffett, the legendary investor. It was clear from his very early years that he was a financial prodigy. By the time he finished high school, for example, he had already sold his first business for $19,000 in today's money. Although he had already clearly developed very strong financial and business skills, he still enrolled at Columbia University so he could get daily mentorship from his older, wiser tutor Benjamin Graham. In our case, even if we identified a strong S.Y.S.T.E.M pattern indicating that the trend is about to go up, we still want to get confirmation from our older mentor, the higher time frame, that the trade is indeed a very high probability one. So, have you ever got mentorship from someone wiser or more experienced than you? You certainly have. Have you ever traded against the trend? I certainly have. And how did that work out? Not very well, right? So the trend is your friend. And the higher time frame is just like your in-laws. You may not necessarily like them, but you can't ignore them. Next, what I'm going to share with you is something that 99% of all traders get wrong. And I wonder why most traders lose money. It goes against all conventional technical analysis. Understand this, and your trading will be profitable and exciting. Ignore this, and you won't understand why trades go against you, even though all the indicators in the world gave you the same signal. So do you want to know what this is? Well, each S.Y.S.T.E.M pattern needs to be exclusive. That means the moment you spot a pattern, you must place your order to enter the market at the base of that pattern, the yield. You must enter the trade the first time the price comes back to the yield area. If it's the second or more time that the price comes back to that level, it's too late. That area is not exclusive anymore and you don't take the trade. Imagine we are at the top of the market before a very sharp fall is about to happen. The market drops, and why is that? Because there are more sellers than buyers, right? Then we have a period of sideways movement, the yield, because there are roughly as many buyers as there are sellers. Eventually, let's say the market rises because there are more buyers than sellers, right? So in our example, let's say you're Goldman Sachs and you need to buy 1 million contracts at the yield level. You manage to buy a certain number of contracts before the market shoots up. Like we said, what are you going to do the moment the price comes back down at the yield level? You're going to continue buying and finish filling your 1 million order. Now, what happens the second or the third time or more that the price returns to the yield level? You, as a bank, you're finished buying, and chances are that so have the other banks. So there won't be much demand at that level anymore because you, alongside the other banks, are done with your buying. Therefore, the price will drop past that area. Therefore, that pattern is now invalid. Makes logical sense, yes or yes? So, have you ever traded a support and resistance level that seemed to have held many times, and then you open the trade and you see that the price goes right through the support or the resistance level, and that trade becomes a loser? How much did that cost you? And how would you have avoided that loss, potentially even profited, had you known this very simple concept about exclusivity? Traditional technical analysis says that the more times a given support or resistance level is tested, the better. And as we just saw, that makes no logical sense. The opposite is actually true. The more times a given support and resistance level is tested, the weaker it becomes. The last point in the stress-free trader system will blow your mind. I will show you how you can lose 7 out of 10 trades and still be profitable. This is something that most retail traders get wrong, and this is something that the Wall Street traders get right. So pay attention, and you too will be able to trade like the big shot Wall Street traders. Consider this. If you trade with a reward to risk ratio of 1-to-1, that means that for every $100 that you risk, you're aiming to make $100 in profit. So say you're right half the time. Okay? After commissions, though, you're still going to be at a loss, even though you've won 50% of your trades. Consider this instead. Let's say you use a 3-to-1 profit ratio. That means that for every $100 you risk, you're looking to make a profit of $300. With good money management, you can still be wrong 7 times out of 10 and be profitable at the end of the week. Crazy, I know, right? Let me prove this to you. Let's say you trade on a 3-to-1 reward to risk ratio. Let's say that there's a 50-50 chance of the market going up and the market going down. Let's say you place 10 trades that week, and indeed you win 5, you lose 5. So you cash in $300 for each winning trade you place. That's a total profit of $1,500. You lose $100 for each losing trade you placed. That's a total loss of $500. So your net profit, if you pick your trades randomly, 50% chance of going up, 50% chance of going down, essentially the chance of a monkey randomly picking the direction of the market, at the end of the week, you will still be up $1,000. Now, let's see what happens if you totally screw this up, or the monkey does, and you don't get 5 winners out of 10, but rather you only get 3 winners out of 10. So, you cash in $300 for each one of your 3 winners. That's a total profit of $900. You lose $100 for each one of your 7 losing trades. That's a total loss of $700. So even if you get 3 out of 10 trades right, you're still going to be in a net profit of $200 at the end of the week. Isn't that cool? Let me ask you this. Have you been using a reward to risk ratio in your trading such that you're putting the odds in your favor and you're consistently profitable? If you haven't, where have you been falling short? How would you like to get only 3 out of 10 trades right and still be ahead of the game at the end of the week? Trading is not about being right most of the time. It's about stacking the odds in your favor. So that's the stress-free trader system, and it's just one of the systems that I teach my students in my Forex Income Accelerator Masterclass, where you don't just learn these, but you implement them and you get real-time feedback on your trading. I'm going to be teaching you another system in the next video in this series. Let me tell you why you must watch it. Because if you ever sat in front of your computer screen reading about conflicting strategies from different gurus, with one expert trader saying you should follow fundamental analysis and the other one saying you should follow technical analysis and price action, and you just don't know what to do. Or maybe you've been buying course after course, system after system, and you've been thinking, I have no clue who I can trust. I need to make trading work for me. Well, then you want to make sure you get my Trend Spotter formula. It's a proven formula that I perfected after working for over 7 years at the highest levels of finance and trading that not only gives you a crystal clear clarity on when we have a strong trend in the market, but it also may as well make you a fortune in your trading. Oh, and one last thing as well. Would you do me a favor, please? I really love to hear from you. I love to hear your feedback. What is it that you learned in this video that stood out for you? And how are you going to use this stuff in your very next trade? The very next time that you look at the markets. So, underneath this video, you will see a place where you can leave your comments. Go in there and leave your comments and tell me how this training you saw today transformed your trading. So, until next time, I wish you all the happiness and all the wealth in the world.